Well, thanks very much, and good morning, everybody. I'm going to just say at the outset that Evan Cooperman did a major faux pas on 3 counts, because I made it very clear that when I give presentations that there are no windows, no food, and the bar is always open.
No sharp comments.
Now, people at the back, can you see this? Can you see the slides? That's good. Okay. So I just want to then say recommendation, which is to get your minds out of the gutter. Okay. Soft now, hard later does not mean I'm the Pfizer analyst. Okay. We're talking about the economy, and we're talking about that this year was the year of the soft economic landing. I know everybody wants there to be a soft landing in the economy where things miraculously slow after one of the most pernicious interest rate cycles compacted in such a short time period. Everybody is yearning for there not to be a recession. But the reality is that recessions are part and parcel of the landscape. And they typically follow periods of aggressive central bank tightening, especially in the US and in Canada. So I think next year is going to be the year where we get the hard landing. I think we're going to have a recession. I don't think the stock market has bottomed. I would actually advise everybody to resist the temptation to believe that you want to chase these bear market rallies. And the most pronounced run-ups in the stock market, like we saw yesterday, are typically short covering rallies. We've seen a lot of them this year, and they typically happen more in bear markets than in bull markets. I'm very bullish on long-term interest rates. Bond yields are coming down. Central banks control short-term interest rates. They don't control long-term interest rates. And long-term interest rates are actually telling you that we're going to have a recession next year. And I think long-term rates, in terms of whether you're going to do your financings, you have time to be patient. I think long-term rates come down. And I'm not one of these people that believe that we're in some sort of new era on inflation. I hear this all the time, deglobalization, and people retiring early, that is compressing the supply of labor, that somehow COVID has created a long-term inflationary cycle. I don't believe that for a second. I think inflation is going to come down to where it was pre-COVID. I think a lot of people on the other side of that trade are going to be surprised. And that's one of the reasons why I am very bullish on long-term interest rates. It's probably my greatest conviction call for the coming year. But let's get into the story. And I don't know if I'm doing this right. There we go. People ask me who my favorite economist of all time was. And it was a physicist. Nobel laureate Albert Einstein, who famously said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And this, I got to tell you, if you're a borrower, and who in Canada isn't, how did we get into this massive, people talk about the lack of supply of Canadian housing. Really? Really? 9% of Canadian GDP is dedicated to residential construction. That's double what it is in the United States. No country in the world has that. We're running housing starts in Canada on a proportional basis, double what it is in the United States. We're almost basically 300,000 on housing starts, 270,000. It doesn't get harder than that. That's double the relative strength in the United States. People talk about the supply. No, it's been an unrelenting demand boom. Part of it, by the way, as the federal government shoots itself in its foot, you can't let in 700,000 people in immigration. And we could do it for social reasons, true, but that creates instantaneous demand for housing right there. We're more than double the historical norm in immigration in this country. I know we're all social advocates, I get it, but you can't have it both ways. You cannot have this immigration policy and then say, oh, we want home prices to actually be at more affordable levels. So that's just put the Bank Canada into play in terms of raising interest rates aggressively, because at some point home prices have to break, and they are breaking, but for the wrong reasons. Because for affordability, you're there as a renter, you want to buy housing, you want prices to come down to increase the affordability, but mortgage rates are going up, and the banks are tightening credit standards at the same time. So the point I'm making here is that this has all been demand-led. Demand by credit accessibility that was beyond the pale, and ultra-low interest rates that stayed low for too long. And that's the reality of the situation. And that's what Albert Einstein's talking about. Now let's talk about Jerome Powell and everything I'm talking about here about the U.S. because the U.S. has actually better data and more up-to-date data than Canada. But Canada is just the United States divided by 10. We are the 51st state, but we're nicer people, and that's basically it. So Jay Powell tells us at the end of July that there's significant additional tightening in the pipeline. And of course, Tiff Macklem's done the same. So this just traces out what this interest rate cycle looks like against its predecessors. We've lumped in what's usually years of interest rate increases just into the past 8 months. And we're up almost 400 basis points. And yesterday, the stock market goes crazy because Powell says, oh, we're not going to go 75 basis points anymore. Oh, we'll just go 50. Gee, thanks for coming out. You're only going 50 basis points. That's great. And this is what the futures market is telling you right now, the rates futures market. This time last year, it was zero. This time last year, if I'm talking about perpetually low interest rates. Then all of a sudden, Jay Powell moves from Bambi to Godzilla, and all of a sudden, the rates market's telling you that we're going up at least another 100 basis points. Over 5%, from zero. We have only seen this in the past, and I'll get into it, back in the early 1980s under Paul Volcker, and that was no walk in the park. Then we have to layer on not just interest rates, but the fact that the Fed is reducing the size of its balance sheet. $95 billion of shrinkage in its balance sheet. Remember, the balance sheet was a big part of the Fed easing over the course, since the great financial crisis. And now they're shrinking their balance sheet by $95 billion a month, both treasuries and mortgages, and that's equivalent to the Fed raising rates 20 basis points. So when people say to me, oh, they're going to pause. They're going to pause soon. Yeah, but they're still going to be doing quantitative tightening. And that's still going to have an impact on the financial markets and on the economy. And this is the one thing we have to pay attention to if you are long risk, if you are long equities, is what else in life has a 90% correlation between the Fed's balance sheet and the stock market? Over 90% correlation. This reminds me of the story, where, Morris comes home and catches his best friend Norman in bed with his wife Sylvia for the past 40 years. And he says, Norman, I have to, but you. So anyway, you don't have to be that person to go chase all these bear market rallies. The trend is not your friend, right? Like basically, don't fight the Fed, works in both directions, but people don't understand what's happening with the balance sheet, and it's ongoing. And it has over a 90% correlation with the stock market. So you tell me, what is the reason to be turning bullish on equities as an asset class? There's other things that we can turn bullish on. I like interest rates. I like short-term corporate debt. There's parts of the high yield market even like, and I like government bonds. I like income right now. Now, the one thing we want to do is we want to play the odds. We always want to be respectful of the probabilities. So here it is. Here it is. It comes down to what Albert Einstein said about the power of interest rates being the eighth wonder of the world. Look at this table. This table contains all the tightening cycles in the post-World War II period. Let's take a look at this. Because this is what I was saying when they started raising rates in March. I said we're in a whole new game right now, a whole slippery slope. Because when they're raising rates, they don't stop at one. Just like when they're cutting rates, they don't stop at one. And I know, don't fight the Fed. People like to talk about that when they're cutting rates. Buy the market, don't fight the Fed. Buy the markets, don't fight the Fed. But all of a sudden, when they're raising rates, you don't hear about don't fight the Fed anymore. Because there's a constant bullish bias. You see, the reason why I stand out as this perma-bear, which I'm not really, I just like to have people stay out of trouble, is the bullish bias in my industry. The financial industry, the bullish bias is incredible. But sometimes hope is not going to triumph over experience. Capiche? So let's take a look. I said in March they start raising rates. There's been 14 hiking cycles and 11 ended up in recession. Let's call that 80% odds. Now, I didn't say at the time it's 100%. I said, well, let's do a tip of the hat for the soft landing. The soft landing is the economy slows just enough that it doesn't go into reverse. And believe me, economic contraction, when GDP takes a haircut, okay, much different story than slowing down from 4% to 2%. Two different animals. A recession is a contraction in economic activity. And it has different characteristics than the beloved and fabled soft landing. Well, in the mid-60s, the Fed accomplished it. Now, you heard Powell yesterday saying, hey, we haven't given up on the soft landing. I got news for you. I have. In the mid-60s, we got a soft landing. The Fed tightened, but we slowed the growth, didn't contract. What happened, of course, was LBJ's, guns for butter fiscal policy. The fiscal deficit in the United States in the mid-60s, in a span of 3 years, it doubled. We're not getting that this time around, and certainly not with a split government in the United States. There's no fiscal stimulus coming. That's in the rearview mirror. Put that aside. The mid-80s, coming out of that recession in the early 80s, Volcker's tightening again. Oh, no recession, soft landing. Well, what happened was oil prices collapsed 70%. And that provided a massive tax cut, de facto tax cut for the American proletariat. Is that happening this time? I doubt it. And then in the mid-90s, remember Greenspan took the funds rate from 3% to 6%. Now, admittedly, it was not a soft landing for Orange County or for Mexico, but the economy slowed without going into recession in the mid-90s, and that's when Alan Greenspan got the label, the maestro. But he had nothing to do with it, because what happened in 1995 was that Netscape went public and ushered in the internet wave that generated a half-decade of massive equity market wealth and productivity, which, of course, at some point, that ended too. But what I'm saying here is that let's play the odds. These central banks are pretty powerful. There's nothing more powerful than the Fed, that is for sure. Not the Bank of Japan, okay, not the Bank of England, not the ECB, not even the PBOC, and not even Tiff Macklem, okay? The Fed rules the roost. And I'm saying, at the time, 80% chance of recession. I was never saying up until now it was going to be 100%. And the one thing I just want to say from a big picture, trace the cycle. Trace the cycle. This is the work that I've done, okay? Painstakingly went back in time to look at the economic growth, real GDP growth, 2 years before they start to raise rates. Average median, called 3.5% to 4%. Oh, that's a sweet spot. They're not hiking rates. The economy is booming. Great. Then you go into the tightening cycle. You see the middle column, and the economy even accelerates further. It continues to accelerate because it's still feeding off the lags from the previous declining interest rate environment. You see there's lags involved. Look at the middle column here. You're basically 5% growth when the Fed is hiking rates, and that's why they're hiking rates. You've gone from strong to super strong, and they're hiking interest rates. Then take a look at what happens the 2 years after on average. Look at that slowdown. And although it's positive, more often than not, those include recessions. I'm just talking about what the next 2 years are going to look like. It's going to be very sluggish. And what's interesting is that in this cycle, this has been a very short, what's it been so far? Call it like 8 months of a tightening cycle. GDP growth is running less than 2%. Not negative, ... yet. Do you see anywhere here in history where during the tightening cycle, GDP growth is as low as 2%? It's usually close to 5%. You see what I'm saying? We've never seen the Fed or the Bank of Canada tighten policy into such a, shall we say, subdued economic environment. But let's just do the math. How many accountants are in the room? You know that economists are accountants, but with personality, just so that I'll throw that in there. You see what happens? We're 2%, never that weak, and historically in the 2 years after the tightening cycle, GDP growth, the subtraction in growth is about 3 percentage points. So you tell me we've averaged less than 2, you usually get the next 2 years, call it 3.5 percentage points or 3 percentage points lopped off. How do you not go negative? How do you not go negative? And is this a story that I want to tell? No. But it's a story I think that has to be told because, frankly, you're not going to hear it from anywhere else because I worked at banks my whole life. And then I worked at Gluskin Sheff. And when you work in an institution, you have to pitch product. I don't have to pitch anything anymore except my view, thankfully. Powell at Jackson Hole at the end of August says, I'm going to bring pain to households and businesses. Ooh, daddy. Like I said, from Bambi to Godzilla. It was just like a year ago. He was like the nation's resident social worker. And look what's happened. But households are paying attention, right? This is why I love using U.S. data there's such a rich database. This is the University of Michigan. It goes back to the 50s. This is the monthly survey of consumer attitudes. And look at the percent saying now's a good time to buy a large household item. It's below where it was at the lows of previous recessions. You don't get much lower than that. Auto buying intentions, home buying intentions have collapsed. And why? Because of interest rates. He was going to bring pain because of high interest rates. And indeed, he's brought the pain. You know, when I would show these charts at the beginning of the year, what households were complaining about the most was about inflation. Prices too high, prices too high, prices too high. Let me tell you something. The inflation is in the rearview mirror. What are they lamenting now? Bad time to buy an auto, bad time to buy a house? Interest rates. Yes, he brought the pain. And this is what the household sector, 70% of US GDP, over 20% of global GDP is telling you. Right now, their principal concern. And you have the Fed, the temerity to say we're going to slow down from 75 basis points to 50? As if 50 is insignificant, or even 25. And it's not just about the cost of credit, but the access to credit. You see what's happening now? The banks are taking on loan loss reserves. Although that you hear all the time, oh, but default rates are low, default rates are low. Yes, but they're on the rise. It's about the change. Life is not about level. Life is about change. Financial markets are about change. And the percentage of people saying that now they're having access to credit problems. This is going to be a big restraint on economic activity next year. Is at its highest level since, guess when? Since the Volcker years of the early 80s. And then we get into the Fed tightening into an inverted yield curve, just like the Bank of Canada. Who knows what the yield curve is in the room? Because now I'm talking, there's a couple people, okay, we'll play a game of bridge after this is over. Look, this is very important. The yield curve is, for anybody that is, I'm sure everybody here is an investor, okay? And I don't mean to preach. But if you're an investor in the capital markets and you don't know what the yield curve is, you got to get on board and figure out the yield curve because it is the best leading indicator for the economy that there is. Okay, the yield curve is the interplay between short-term interest rates and long-term interest rates. And because of the time value of money, in a normal period of time, there is a positive spread between long-term rates and short-term rates. You get paid, right, to be longer term. Normally, short-term rates might be 3%, long-term rates 5%, but you see we're inverted. We have this unusual period of time where the central banks have raised rates so much that short-term rates, which they control, is above the level of long-term interest rates. I'm trying to tell you that is abnormal. Not that it hasn't happened in the past, but it is a great recession indicator. It is the bond market's way of saying to the central bankers, uncle, okay? That is the pain that the central bankers have brought on their own mistake because they kept policy too easy for too long after it became clear that COVID was not the bubonic plague. So the San Fran Fed did the work and said the power of the term spread, which is lingo for the yield curve, that its power to predict economic slowdowns appears intact. And here's what the yield curve looks like. This is the gap between short-term rates and long-term rates when it goes below zero. Now, unfortunately, on this screen, you can't see the recession bands, but this is the best leading indicator for recession that there is. And look where we are. We're the most inverted since 1981. What happened in 1981? Well, then we had 1982. We had one of the biggest recessions, the post-World War II period. And I'm watching these clowns on Bubble Vision talking about soft landing. And I'm just thinking, oh boy, they're going to get people in the same trouble they did when they said the same story back in 2007. Okay? It's a minus 75 basis point inversion. The yield gap between 2 years and 10 years, minus 75 basis points. In Canada, it's minus 100 basis points, and you have the same people you read about in the Globe and Mail talking about a soft landing. These people are destined to get you into trouble next year, and I've seen it before. And then we have a Fed right now which is trying to dream up ways to stay tight. Best article I saw on this was Greg Gipp a couple of months ago, where he says that the Fed's move defy expectations and formulas. They don't have an anchor. They're just freaking out about inflation, which is a lagging indicator. Inflation that was brought about by the COVID and all the byproducts of the COVID. And the point here is he's focused on non-farm payrolls. We're getting the November number tomorrow, unemployment rate. He's focused on inflation, which is in the rearview mirror. So do you see when I hear people talk about, well, wages? Well, look, the wages go into the Conference Board's index of lagging economic indicators. Unemployment's so low, that is a lagging indicator. And you see what's happened is that the Fed is focused on that chart on the left. Now, I don't know why. They're not stupid guys. But the reason why you hear so much the economy is doing fine is because the lagging indicators are still going up. And the coincident indicator is still going up. He talked about non-farm payrolls. That is a coincident indicator. I've spent my professional life trying to drive the car, looking through the front window and not the rear view mirror, and I got the Bank of Canada and I got the Fed looking at these two charts on the left. When the chart on the right is what we should be looking at, which is the index of leading indicators. And they're going down. And in fact, the index of leading indicators, and this is a data point from the Conference Board in the United States, down 8 months in a row. Does not happen that often. And when it's down 8 months in a row, and again, the recession bands aren't there, but we have a recession staring us in the face in the next 3 to 6 months. So guess what? You do have time to prepare. And we have Paul Volcker. And the reason I bring up Paul Volcker is because for the past 8 months, all Jay Powell has done is compare himself to Jay Powell, the best economic public servant of his era. And in fact, in early September, in his testimony, Jay Powell says, we're going to keep at it. He stole the title of Paul Volcker's book that he wrote just before he died. Keep at it. And you know the sad thing about this is that Paul Volcker's not even alive to collect the commission on that. Okay, you're going to tell me central bankers, oh, we got the big inflation. Let me tell you something. Central bankers, if they want to drill inflation into the ground, they'll do it. Deglobalization, labor supply, they'll do what it takes. They will do what it takes. Okay, the last thing that these people want to be remembered is that they created the inflation of the 1970s. Okay, that's just not going to happen. And so we know what Volcker did. Volcker created the conditions for back-to-back huge recessions, a big increase in unemployment, almost doubled, 3 million job losses, a 3-year bear market in equities. A 3-year bear market in equities. Remember, this guy, Powell, is comparing himself not to Arthur Burns, not to Alan Greenspan, not to Janet Yellen, not to Alan Greenspan. He's comparing himself to Paul Volcker, who we revere. We revere Paul Volcker today. Most people alive don't even know who he was, but they know, oh, he killed inflation. Yeah, because he killed demand. And he killed profits. And for a period of time, not forever, I mean, he did form the foundation in 1982 for a 20-year bull market, but there was 3 years of pain before that, and that's where we are right now. Now, the one thing about Powell that I can't really understand is he says to us when they started raising interest rates, he says, we are not going to make any assumptions about an improvement on the supply side of the economy. No assumptions. And you see, this is a case of once burned, twice shy. Okay, because nobody thought inflation was going to go as high as it has, whether it's in Canada or the United States. Nobody saw inflation going up, and these guys were totally embarrassed. He's getting compared to Arthur Burns in the 1970s. He's the big inflation creator. And at some point, Powell said enough is enough, and he got buy-in from Joe Biden and the administration. And everybody on the committee at the Fed is all foursquare behind him and his comparisons to Paul Volcker. But he's there saying, I'm not going to focus on the supply side of the economy. Well, I don't know, when I went to economics school, Economics 101, when they taught us how to forecast prices, which is what inflation is, I seem to recall we needed a supply curve and a demand curve. So you understand what I'm saying here is you've got a central bank that's saying we are only focused on demand. Demand. We're not going to make any assumptions about supply. But do you not see what's happening? The supply side is already thawing out. You're seeing it on global freight rates. Supply delivery delays, which is the poster child for global bottleneck pressures, are down to a 13-year low. Prices in the surveys are down to almost a 3-year low. Commodity prices are that's what got the ball started, right, with commodity prices. And they're well off the peaks and across the board. In fact, you know what? I write a daily report, as was mentioned earlier, called Breakfast with Dave. I got news for you. Breakfast is deflating. Milk, soybeans, corn, wheat, commodities are coming down. And I think people will be surprised the impact this is going to have on inflation in the next 12 to 24 months. To quote my second favorite economist of all time, who's a portfolio manager at the Oracle, What we learn from history is that people don't learn from history. I said that before about the yield curve. Oh, don't worry about the yield curve. Yeah, the yield curve is telling you recession's around the corner, but I love the fact that there's so many people resisting. Because when it becomes universally well accepted, I'll be on to becoming more bullish. That'll be next year. But let's talk about this inflation. Oh, the inflation. No kidding. We had COVID and then the first shooting war in Europe in 80 years. And wars are inflationary. Pandemics are inflationary from the cost side. Demand hasn't changed. Yes, we had stimulus checks for a period of about a year. And it's all in the rearview mirror. It's all been supply side led. And now the supply side's improving. But you see, we only have a sample size of one, which is what happened a century ago. Back then, we had a war first, World War I, which was inflationary, and we had the Spanish flu, which was inflationary. And in fact, I would argue this was transitory. For all the people like myself, oh, there's the big clown, Mr. Transitory. Yeah, well, you know what? In the overall annals of economic history, I would say 18 months is pretty transitory. Wouldn't you? So we have the situation where, with the Spanish flu in World War I, 5 years of double-digit inflation. And guess what? When those supply-side pressures subsided, which the Fed isn't paying attention to, guess what happened? 10 years of either disinflation or deflation. It took 20 years for the CPI to get back to where it was beforehand. That is what's staring us in the face. As everybody focuses on yesterday's story, which is inflation, I'll just tell you the future is one of disinflation and deflation. We're going back to where we were pre-COVID, just like what happened in the 1920s. You know, F. Scott Fitzgerald writes The Great Gatsby in what year? 1926. Was there anything in there about the great inflation? They had 5 years double-digit inflation. I wouldn't even call that transitory. So I would say the future is going back towards disinflation, deflation, which is why I think long-term rates are coming down. Now, I got to know how I'm doing for time. Because I'm good? Because I'm on a roll. We could be here for lunch, but the windows are locked, okay? So I'm there thinking about what is the Fed really up to here? They have to know. They have to know everything I'm talking about. What is it they're up to? And it reminds me not of Paul Volcker, but of William McChesney Martin. And again, there's statues of him in Washington too. And he was there for many, many years. 1959 at a banking conference, this is a famous quote about taking the punch bowl away. You've heard that quote about the central banks taking the punch bowl away? You know that one, right? This is a famous quote in the capital markets industry. Everybody who's in this industry knows this quote. But you see, he said, in the position of the chaperone who has ordered the punch bowl removed just when the party was really warming up. And the problem for Jay Powell is he started removing the punch bowl at 3 in the morning after he spiked it for everybody for a period of an extra 18 months. But this is actually the key here. The key is what he was saying at the time was I'm trying to break the link between the real economy and the financial economy. It's gotten too unhealthy. We had 2 recessions separated 4 years apart after this comment, and the stock market went nowhere for 3 years. And the bears were left, the bulls were left flummoxed. Who is the real Jay Powell? I mean, everybody was stunned because he was talking about, during the pandemic, about inclusive unemployment rates and the downtrodden and social policy. And all of a sudden, he became this cuddly teddy bear. And everybody was thinking in the financial markets, you got to buy risk. You got to buy meme stocks. You got to buy crypto. You got to buy the most speculative stocks because this guy is just going to keep the liquidity spigots on to perpetuity. And then they went back and they thought, back in 2019, Trump was on his Twitter account lambasting him, stop raising rates, cut rates. And then in 2019, he's cutting rates because Biden wasn't in charge, and Biden has given him the support. Trump was just relentless. So people have this mistaken view about Powell. Powell is hardcore. You think I'm a bear? This guy is a policy hawk to the core. And people got him wrong because a temporary period he went astray and he became the resident social worker. He'll just keep rates at 0 forever just to benefit everybody. Yeah, until the bubbles start to surface. And they realized, like Mary Shelley, that he created Frankenstein. So he's taking a look at his time when he was governor, before he got on the pedestal and he became Fed chairman, when he was governor. Look at the things he was saying back then. He was saying experience suggests that low real rates, if maintained for a long time, can lead to asset price bubbles and eventually to financial instability. I could have filled up this page with more, but you wouldn't be able to see the font. He says, I'm more concerned with the second risk, which is that more accommodative policy could lead to frothy financial conditions. Oh, tell me that Cathie Wood was not like the poster person for that. Frothy financial conditions and eventually undermine financial stability. Well, the crypto space hasn't done that yet, but it's starting. And then a long period of very low interest rates could lead to excessive risk-taking and over time to unsustainably high asset prices and credit growth. He said that in 2016 when Janet Yellen was chairperson. Yeah, I know, same guy that was dishing out the drinks on the punch bowl. That game is over, and believe me, he regrets it. The guy is a human being after all. We're all prone to make mistakes. This is the real Jay Powell, okay? And what he's saying is he's taking the punch bowl away. And this is why he's taking the punch bowl away. And this chart looks the same in Canada. In fact, it's worse. Household net worth relative to after-tax personal income. Tell me, does this chart look normal to you? Look at that. I'm rich, I'm poor, I'm rich, I'm poor. It's become an economy too dependent on financial assets or on assets in general. We don't even think anymore in this country about the house that you grow your kids up, you have your backyard. Historically, real estate, yes, great hedge against inflation. What real estate agent didn't tell you, great hedge against inflation, but not going up 15 percentage points over inflation. Historically, more like 2. It's gone insane. So this is what we're talking about here. Do you know that if we mean revert this chart from 810% down to 610, it's already starting, the negative wealth effect on spending in the world's largest economy, that's an 8% hit to GDP. That's twice as bad as what we saw in the Great Recession back in 08 and 09. And the San Fran Fed, yet again, the best Fed research comes out of the San Fran Fed, says this ratio tends to mean revert, and it does not remain at extreme values, either high or low, for prolonged periods. It's a mean reverting series. So when people say to me, show me one chart that tells you that it's not going to be a mild recession, I say, okay, I'm just going to go to page 41. And here's what we got. Homeowner, I was thinking at the beginning of the year, my biggest fear, $45 trillion of naked long positions on household balance sheets and equity market. Heading into 07, 08, 15 trillion, we tripled, and look what's happening. You're starting to see the compression already starting in household balance sheets. There's more to go. There's more to go. This is equities as a share of financial assets and household balance sheets. We're still overexposed. We're still overexposed. And that to me is the biggest risk, is what happens to the negative wealth effect on spending. The same thing in Canada. Look at home prices. Another $45 trillion asset class. And I don't know if you've noticed, of course, we know that home prices are going down in Toronto and Vancouver, most parts of Canada. They're starting to they're coming down globally. This was a global housing bubble. It wasn't just Canada, although ours is about the biggest in the world, tied with Australia and the UK. Home prices are decelerating. But even after this recent deceleration, home price growth is still higher than it was at the bubble peak back in 06 and 07. It takes 8 years of income to buy a home. When you're taking a look at a PE multiple in housing, 8 years of income to buy a home. The long run norm is 5. You're asking how nutty is the market? Do you know that in Canada it takes 11 years worth of income? It takes 11 years. In the US it's 8. Our bubble is much bigger than it is in the United States. And it means that the home price decline is going to be more pernicious. 11 years in Canada is about double the historical norm. 8 years in the US, about double the historical norm. Well, let's get into what this all means for the markets, okay? So the stock market always peaks before the recession because the stock market, after all, is a leading indicator. Stock market goes down more than 9%. Recession starts. During the recession, it's down 22%. The whole thing, you're down roughly 30%. So that's what I mean when I say playing the averages. No, we have not bottomed. This chart more or less shows you, and again, we don't have the recession bands here. It's unfortunate. But when we're at the trough on the stock market, we're basically 70% of the way into the recession. The recession hasn't even started yet. I mean, think about that. How could the stock market have bottomed? And I'm just asking as an interested observer. Maybe you can educate me. The recession hasn't even started yet. It's next year's story. We've never had the stock market bottom. before the recession starts. It usually starts 3/4 of the way, basically the 7th inning of the recession, the stock market bottoms. And you get these bounces, and everybody gets all excited. And I'm trying to say to my clients, please, please don't hyperventilate, okay? And you can see the bond yields come down through the piece and then stay low. And I am very bullish on bonds. And during recessions, by the way, bonds are where you want to be. Bond yields go down 150 basis points. You're going to say to me, wow, do you think we're going back to roughly 2.5% on the 10-year note? I'm saying absolutely, that's my forecast. And if I'm right on that, the bond market is going to make you 20 to 30% with no equity risk. I don't think the stock market's going to make you that money. So this is how you have the recessionary playbook. In a recession, what you want to own and not own. What you don't want to own is all on the left. Like, for example, emerging market equities. And right now they've had a little bounce. Why? Because Beijing might start to ease up in its restrictive zero COVID policy. Okay, run with that if that makes you excited. The history shows you in recessions, emerging markets are markets that you can't emerge from in an emergency. Okay, I'm not going to repeat that again. And then you can see the stock market, Canada, US, commodity prices down almost 15%. Gold and the US dollar hold their value. You want to be in cash, especially now these central bankers are paying you to be in cash. What's wrong? Cash is king. And it will remain that way for the next year. Government bonds, I would say in the equity market, narrow your tranche to non-cyclical blue chip companies that have a history of never cutting their dividend. Okay? Maybe that's the case for the Canadian banks, I'm not sure, but dividends in this environment in non-cyclical parts of the market do well. And of course, volatility. And there's ways you can play volatility through the derivatives market. But your options are narrowed in a recession, but that's what works. The Wall Street Journal recently said you can't predict when bear markets end, so don't try. But I am tenacious, so I'm going to try. Firstly, I say don't fight the Fed. All the bulls were saying don't fight the Fed from March of 2021 to December 2022, and they were right. Nobody says it anymore because, you see, it's not a bullish story. And everybody wants to be bullish. But you see, you have Neil Kashkari from the Minneapolis Fed basically telling you after last Jackson Hole that he was not happy to see the stock market rally because they thought the Fed was turning bullish. See, look what he said at the end of August. I'm not excited about the fact the stock market misread us. And yesterday, we had a 737-point surge in the Dow because everybody thought, oh, he's only going 50 beeps. Isn't that great? Into an inverted yield curve. I'm there shaking my head thinking, this is insane. Don't fight the Fed. The Fed's telling you, do you see, the Fed's telling you they want asset prices to go lower. They want to break the link between the financial economy and the real economy. Now, there's always a symbiotic relationship, always, between the real economy and the financial economy. Call it Main Street and Wall Street. But it's reached a, call it 3 standard deviation event. It's become unhealthy. So you see what Powell's really doing when I say take the punch bowl away. He is, in his last term, this is the first year of his last term, he is single-handedly repudiating the Greenspan, Bernanke, Yellen doctrine of always stimulating the economy to generate higher asset prices. That's what's ending. So we know that at the lows in the stock market, we know what bear markets look like. What is tried, tested, and true at these famous lows, because there will be a low in the stock market. That's just a fact. We just don't know when. But we know that there has never been a low in the stock market that didn't include the Fed cutting interest rates. I don't know. I didn't hear Powell say we're cutting rates yesterday, but the market seemed to think, wow, at least he's not going 75 on the upside anymore. Not good enough for me. And again, this table basically says it all. Lots of information here. The pause when the Fed stops raising rates, the start of the recession, the first cut, which will come. We just don't know when. And then the stock market low, which everybody wants. You know, from my client, I got 2,800 clients in 40 countries. And the questions every day come into the inbox. Are we there yet? Are we there yet? Are we there yet? It's like I got my 3 sons. It's like I'm back 20 years ago and in the back seat of the car on the way to Mount Tremblant. Are we there yet? No, we're not there yet. Stop it. I'll let you know. So basically, you have all these periods, okay? Back to the late 60s, the Fed pauses. They'll probably pause early next year. But be careful what you wish for. Because all the bad stuff happens after they pause. Because all the lags, because the interest rates, everybody's resetting into the new interest rate environment at different times. You see what I mean? I showed you before the lags are like 1 to 2 years. It's just going to be starting in the coming year in terms of the peak impact on the economy. So yeah, the Fed is going to pause, and then the recession historically is about 6 months later. You're going to find the Fed's going to pause, and people are going to be dancing. The Fed's paused, and they're not going to see that the lag, that all the bad stuff's going to happen, and that includes the economy. It includes job losses, and it includes credit defaults. Nothing anybody's talking about right now, except I guess I'm talking about it. And then inevitably they're going to cut rates. But look where the market bottoms. Okay, I was at Mother Merrill. July of 06, the Fed pauses. Great. And they actually start cutting rates September of 07. Great. Look at the stock market hit the bottom. March of 09. Oh, you're going to say, that's a special case. It was like the Great Recession. It was the housing crisis. Okay, go back to, they paused in May 00. Did that stop the recession from March 01? They started cutting rates in January 01, and the recession started 2 months later. My phone is ringing off the hook. When the Fed cut rates in January of 01, I'm at Merrill, and my phone's ringing off the hook. The Fed's cut rates. I go, yeah, and all the bad stuff's going to start to happen. The recession starts March of 01. People were saying, how come you're not turning more bullish? I said, because I got to wait. Got to wait to see all the signs. And the market bottoms October of 02, okay? So pack this in your back pocket. When everybody goes nuts when they pause and they cut rates, it's going to be a very difficult year. This year was the year where the interest rate increases caused the price-earnings multiple to go down, and that was a stock market story. Next year's stock market story is going to be the impact it has on corporate earnings. Now, I don't live in a 0 and 100 world. I always operate in between. I've been in this industry long enough to know that you don't put all your eggs in one basket, and there is no such thing as a sure thing, except that this is practically a sure thing. Now, I'll just say that I'm looking for all the signs. I am looking for every opportunity to turn bullish. I want to actually become a perma bull. Okay, that might have to wait a year. I'm just going to say this is the template for what I'm going to look at. Equity risk premium, right? I'm not going to ask who knows what that is, the ERP, but anybody who's managing an asset mix or a credit book or an equity book knows that that is the relationship between bond yields and earnings yield in the stock market. Right now, the ERP, it's called, is 200 basis points. It has to widen to 450 basis points before I turn bullish. You know why? Because I'm going to respect Warren Buffett and say, I'm going to learn from history. And then, the most important thing is the yield curve. The yield curve. It's not so much, you see, the reason why people get all excited, never mind the pause, when they start to cut interest rates, we're going to have another bear market rally. If you're Paul Tudor Jones, or think you are, you can play the bear market rallies. I'm talking about the fundamental low when you can go in and go really long the stock market for the next cycle and sleep at night, despite taking that risk because the reward will be so much greater. The yield curve, number 4. They got to cut rates significantly enough to generate a positive shape to that yield curve I talked about before. That yield curve that right now has got a negative 75 basis point shape. He's going to call his broker, I guarantee it. Either that or he's going to throw up. Historically, you got to steep at 140 basis points. So, and the point I'm making, by the way, the reason why I'm very bullish on bonds is this. Back to point number 1. The horse has to come before the cart, okay? Establishing a higher equity risk premium is going to have to involve bond yields coming down. And when you look historically, once again, to borrow from Warren Buffett, it's interesting. This is anybody, again, who's an accountant. It's FIFO, first in, first out. The asset class that goes into the bear market first, historically, very interesting, by the way, historical anecdote, the first asset class to go into the bear market is the first one to come out of the bear market. So the bear market in bonds started in the summer of 2020. The bear market in equity started at the end of 2021. The bear market in commodities started this past summer in June. And the real estate one just started. Real estate will be the last one to come out, I hate to tell you, but that's the way it's going to play. But the first thing that is going to rally, and it's already starting, is the bond market. And that's my biggest conviction trade, long-term interest rates coming down in the next 12, not just next 12, next 24 months. And probably my greatest pride. After years of working on Wall Street and having the disclaimer 5 pages in a small font, look at what we can do at Rosenberg Research. Anyway, thanks very much, everybody, for indulging me.
Thank you so much.
Pleasure.
And as a token of our appreciation, we have a book for Dave. It's inscribed by Evan, so you can put it up on eBay.
Thanks.
Thank you, Dave.